Hi, welcome back to Joe Blogs. In today's episode, I want to provide you with an update as to what's happening in the Chinese economy. If you've been following the channel, you'll know that concerns are rising that China is now going into a slowdown and that this could have a major impact on the global economy. China is the world's biggest manufacturer and its economy is dependent upon exports. And the figures for June have now been released and show that exports fell by 12.4%, which is the biggest fall that we've seen in more than 3 years. And the reduction in exports in June follows on from a fall of 7.5% seen in May. But China is not just experiencing a problem with its exports, it's also got a problem in its own economy with inflation. So in today's episode, we'll have a look in detail as to what's happened with China's exports. We'll then go through a breakdown of China's top exporting partners and have a look at what's happened with the levels of trade over the last 6 months. We'll then have a look in detail as to what's happening with inflation. We'll have a look at what's going on with the producer price index or factory gate prices. We'll have a look at the Purchasing Managers Index, which gives us an indication as to whether companies in China are expanding or contracting at the moment. We'll check out what's happening with China's currency. And then finally today I'll wrap up with my summaries to what I think is likely to happen in the Chinese economy over the course of the next 3 to 6 months and what the implications of this are for the global economy. This chart shows the annual percentage movement in both China's exports and imports dating back to June 2021. And the scale on the left-hand side of this chart ranges from minus 20% at the bottom to plus 30% at the top. The percentage movement in exports is shown by the dark blue line and the percentage movements in imports by the grey line. And as you can see from the trend of both of these lines, there has been a marked reduction in both imports and exports over the course of the last 2 years. In June 2021, China enjoyed an increase in its exports of more than 30% and an increase in imports of around 40%. However, since that point, there has been a significant downward trend in both metrics. Now, between June 21 and October 22, there was a reduction in the growth of both exports and imports, but it remained in positive territory. However, between October 22 and February 23, China actually experienced a fall in exports and an associated fall in imports. And if you followed the channel, hopefully you'll be aware by now that imports are important because China imports a lot of raw materials which it then manufactures, uses in its processes and then exports those finished goods. So the level of imports gives us a strong indication as to what's going to happen over the course of the next 3 to 6 months for the Chinese economy. So when we see a reduction in the level of imports, that means that China's buying in less, it will be manufacturing less, and therefore in the future it will be exporting less. Now, one of the key issues that was seen as the turning point for the Chinese economy was the removal of all of the COVID restrictions in December 2022. Up until that point, China had been pursuing a zero tolerance policy whereby it was locking down entire cities if one case of COVID was recorded. And of course, that was having a major negative impact on its ability to produce and manufacture goods. So the removal of that policy was seen as a major step forward, and the outlook for 2023 was considered to be very rosy for China. We were expecting month-on-month growth in both exports and the associated imports. And as you can see from the chart, in March, China achieved growth in exports of around 15%, and in April, it was around 9%. However, that recovery was short-lived, and in May, China saw a 7.5% fall in its exports. And in June, the level of exports has fallen by 12.4%, which is the worst performance that China has recorded for more than 3 years. And this level of contraction was a significant surprise for the markets. And if we have a look at what's happened to imports, I think it tells a really interesting story. In January, the level of imports fell by more than 20%. However, alongside the improvements in exports, there was a pickup in February when imports increased year on year. However, in March, April, May and June, China has seen a reduction in the level of its imports. And in June 2023, total imports contracted by 6.8% on a year-on-year basis. And what this tells us is that China isn't buying in large amounts of raw materials, which it can then pass through its manufacturing process. And that means that the outlook for exports over the course of the next 3 to 6 months is negative because China just doesn't have the raw materials available to it to be able to fulfill a huge growth in exports. exports. So all of this is highly concerning from China's perspective because its economy is entirely dependent on exports. So let's have a look at the breakdown of the trading partners that China is dealing with and see what's going on with the specific levels of trade. This chart shows the top 10 export partners for China between January and June 2023. So right at the top of this list, we've got the Association of Southeast Asian Nations, which is an intergovernmental organisation of 10 Southeast Asian countries comprising of Brunei, Cambodia, Indonesia, Laos, Malaysia, Myanmar, the Philippines, Singapore, Thailand and Vietnam. And one of the main reasons that this group of countries is one of China's largest buyers is the geographical location. A lot of these countries are located relatively close. And as you can see from the table, these countries account for around 16% of all of China's exports, as does the European Union, which comes in at number 2 on this chart. The USA is the third largest buyer of Chinese exports, accounting for around 14%, followed by Hong Kong at 8%, Latin America 7%, Africa, Japan and South Korea all account for 5%, and the last two nations making up the top 10 are India and Russia, both of which account for around 3% of China's exports. Now, if we expand this chart out to show the year-on-year movement in the value of exports, it exposes some really interesting data. If we start off by looking at the large blue section at the bottom, you can see that the value of China's exports to Russia have increased by 92% over the last 12 months. And this of course reflects the unlimited trade deal that was announced between President Jinping of China and President Putin of Russia. But the problem from China's point of view is that Russia only accounts for around 3% of all of its exports. So whilst there's been a massive increase, in big picture terms it doesn't really attribute a lot of value to the overall position from China's perspective. Now if we move to the top of this chart and look at what's happened to total exports, you can see that there's actually been a 4% increase year on year between January and June, which at face value seems a bit puzzling because we've been talking about a 12.4% fall in the 12 months to the end of June. However, the data in this table only covers a 6-month period. It doesn't cover the last 6 months of 2022, whereas the annual figure obviously takes account of the full 12 months. If we now look at the data from the other regions, you can see that there are 6 other regions that have also increased the amount that they've been purchasing from China. The 10 Asian countries increased their purchases by 9%, Latin America was up 6%, Africa 24%, Japan and South Korea 2% and India 6%. But unfortunately from China's point of view, a lot of those countries account for a very small percentage. And 2 of its biggest trading partners, the USA and Hong Kong, saw a 12% and 4% fall in exports respectively. And there was 0% growth from the European Union, which is the joint largest trading partner. And with exports accounting for around 20% of the total Chinese economy, and another 20% being directly linked to the property sector, which is also on its knees, the outlook for the rest of 2023 for China is becoming less and less positive. This chart shows the movement in inflation in China over the course of the last 12 months. So as you can see, back in July 2022, inflation was running at 2.7%, which is considered to be a healthy rate of inflation. Most countries around the world have a target rate of between 2 and 3%. And the reason that most governments set inflation targets at around those levels is that it allows an element of growth. If you're a company, you want the flexibility of being able to increase prices, firstly to pass on any cost increases that you're incurring, and secondly to be able to increase the wages of your staff. So this time last year, the rate of inflation was exactly where the Chinese authorities wanted it to be. And in August, September and October, the rate of inflation stayed within that 2 to 3% bracket. However, in November, China experienced a contraction in its economy and inflation fell to 1.6%. It then increased to 1.8% in December and bounced back to 2.1% in January. Now, January was the first full month following the removal of all of the COVID restrictions that the Chinese authorities had imposed for 3 years. They were still putting whole cities into lockdown. And at that stage, it looked like the Chinese economy was going to bounce back strongly and that 2023 would be a very good year for China. However, as you'll be aware, the recovery didn't last as long as everybody expected, and inflation fell to 1% in February. It then fell to 0.7% in March, 0.1% in April, it increased slightly to 0.2% in May, and in June 2023, the official rate of inflation is 0%. So that means that on an annual basis, prices in China today are at exactly the same level as they were 12 months ago. And that is obviously bad news for all Chinese businesses because it means that they can't increase their prices. So they can't pass on any cost increases and they can't increase the wages of their staff without affecting their own profits. And if you take a step back and look at the trend of this chart, you can see that in 2023 there has been a sharp downward trend in the level of inflation. And if we extrapolate that trend throughout the rest of 2023, it's highly likely that China is now going to see disinflation, that we will see falling prices. And of course, that will be a big challenge for all of the Chinese corporates, because if they've got falling prices, but their costs are going up, then that means that they will start seeing falling profits. And that's going to be a major problem for the Chinese economy. And to put China's current situation into perspective, this chart shows the current rates of inflation for the G20, the 20 largest economies in the world. And I've ranked this from the lowest to the highest. So you can see that China currently has the lowest rate of inflation out of all of the G20 at 0%. The next highest is Switzerland at 1.7%, Spain at 1.9%, Russia at 2.5%. And if you've been following the channel, you'll know that I've been questioning that official rate of inflation in Russia because the Russian ruble has tanked in value over the course of the last 12 months. We have seen the ruble fall against all major currencies somewhere between 40 and 60%. So that means that all of the imports that Russia are having to buy in will be considerably more expensive. And usually when we have a situation like that, we have high rates of inflation. So the 2.5% does look a bit unusual. The next highest rate is South Korea at 2.7%, Saudi Arabia 2.8%. The official rate of inflation in Japan is now 3.2%. And that's really interesting because for the last 10 years or so, Japan has been suffering from disinflation, falling prices. And that's been a major problem in the economy. But we're now seeing prices rising, but that doesn't mean that the problems in Japan are over. Canada has the next highest rate at 3.4%, which is a considerable fall against the 4.4% the previous month. So there is definitely a movement downwards in inflation in Canada. Indonesia, 3.52%. Brazil, 3.94%. The USA's official rate of inflation is now 4%, which is a major fall from the previous month of 4.9%. India's 4.25%, France 4.5%, Mexico and Singapore 5.1%, the European area 5.5%, Netherlands 5.7%, South Africa 6.3%, Germany and Italy 6.4%, Australia 7%. Inflation in the United Kingdom is 8.7% as it suffers from a combination of high international prices and the impact of Brexit. And then we have Turkey at 38% and Argentina at 114%. And if you take a step back and look at what's happening for the G20, you can see that there is a clear trend in most of these economies for a reduction in inflation. For the last 18 months or so, we've been talking about high rates of inflation causing major problems in all of these economies. So everybody's been focused on trying to get inflation back down. But if you look at what's happening in China, it's gone too far the other way. Inflation is now so low that it's causing other forms of problems. And it'll be really interesting to see what happens for all of these other economies over the course of the next 3 to 6 months. Because if we do go into a global slowdown, as could be indicated by what's happening in China, it might be that we start to see inflation come tumbling down in all of these other economies, and that we go from one extreme to the other, and that low inflation starts to cause other problems. This chart shows the annual movement in producer prices in China over the course of the last 12 months. And producer prices are also known as factory gate prices. So these are the prices that companies are selling their goods for. And as you can see, back in July 2022, producer prices had increased 4.2%. In August, that level came down to 2.3%. And in September, it fell further to 0.9%. However, from October onwards, what we can see is that producer prices in China actually moved into negative territory. So producers were having to sell their goods at a lower price than they were 12 months previous. And obviously that is going to cause problems for any producer because most companies have rising costs, and so they want to keep increasing their prices. If you have to start cutting prices, then generally speaking, it means that you're having to compete harder to win that business, and it's likely to eat into your profits. So Chinese producers experienced a fall of 1.3% in their prices in October and November. The fall in prices actually reduced to 0.7% in December, 0.8% in January. However, in 2023, things have started to get progressively worse for Chinese companies. In February, prices fell by 1.4%, in March 2.5%, in April 3.6%, in May 4.6%, and the figures for June 2023 show that on a 12-month basis, producer prices have fallen by 5.4%. So that means that on average, companies in China are selling their goods today for 5.4% less than they were this time 12 months ago. And if we expand the chart out to show the position over the last 5 years, you can see that the current fall in prices is actually worse than it was during the COVID-19 pandemic in 2020. So that really puts into perspective how serious this situation is. This chart shows the movement in the Manufacturing Purchasing Managers Index in China over the course of the last 12 months. And if you've been following the channel, you'll know that the Purchasing Managers Index is a survey of thousands of different purchasing managers in a variety of different companies. And the critical score to look at on the index on the right is 50. When the Purchasing Managers Index is above 50, that indicates that businesses are expanding, things are going well, and the purchasing managers are buying in more raw materials in order to produce more goods. However, when the score is below 50, it indicates that there is contraction in those companies, that they are buying less than they were historically, and so the companies are likely to produce less. And what we can see from this chart is that over the course of last 12 months, there have only been 4 occasions when the PMI was above 50. So that means that on the whole, over the course of the last year, Chinese businesses have been contracting. And if we look specifically at what's happened in 2023, it tells a really interesting story. In January, the PMI came in at 50.1%, so that indicates a very, very small amount of growth. However, in February, the index increased to 52.6%, and at that point, everybody thought that the Chinese economy was back into full steam ahead mode, that this was going to be a fantastic year. We'd released all of the COVID restrictions, everybody was now working on a full-time basis, and so we expected the Chinese economy to come in with around 6% GDP growth for 2023. However, in March, we started to see indications that that growth was faltering, and the PMI came in at 51.9%, but in April, it dropped to 49.2%. So that's below the 50% level and indicates that on average, Chinese businesses were contracting. That contraction continued in May when the score was recorded at 48.8, and in June the official PMI index is 49, which indicates that Chinese business is still contracting. And this is a major problem for a growth economy which is based predominantly on manufacturing. We are seeing a contraction in the biggest part of the second largest economy in the world. This chart shows the movement in the exchange rate between the US dollar and the Chinese yuan over the course of the last 12 months. And as we've discussed before, the traditional way of showing these charts is that the stronger currency is quoted first. So that means that when we see an upward movement in these charts, it indicates that the dollar is strengthening and the yuan is weakening. And what this chart shows is that this time 12 months ago, $1 US was trading for around 6.7 Chinese yuan. The exchange rate then fell to a low of $1 US to 7.3 Chinese yuan by the start of November as the Chinese economy started to contract. However, in the first part of 2023, we saw a bounce back in the Chinese economy when the outlook started to look a lot more positive and everybody was expecting 2023 to be a super strong year for China. And by the middle of January, $1 US was trading for 6.7 Chinese yuan. However, over the course of the last 6 months, we have seen a significant weakening in the Chinese yuan as the economy has started to slow down, and the current exchange rate is $1 for 7.25 Chinese yuan, which represents a fall in value of more than 8% over the course of the last 6 months. And I think the exchange rate is really interesting when you're talking about the Chinese economy, because China is a net exporter. It manufactures lots of goods which it exports all around the world. And when you're a net exporter, your exchange rate has a big influence on the amount of business you're doing. So let's talk about a practical example of a product that's being sold by China that's priced at 6.7 Chinese yuan. This time 12 months ago, that product would have been selling in the USA for $1. However, because the US dollar has now strengthened against the Chinese yuan, that same product priced at 6.7 Chinese yuan would be selling in the USA today for around 92 cents. So the fall in the value of the currency means that China's exports should become relatively cheaper in all of the markets it's selling into. So you would have thought that would be good news for the Chinese economy, because if things are cheaper, they should sell more and therefore make more profit. However, what we're seeing from the data is that that isn't happening. We've got disinflation in the Chinese economy, so prices are falling for Chinese consumers, but we've also got factory gate prices falling. So the actual price that goods are being sold at is going down at the same time as the Chinese yuan is falling in value. So what that means from China's point of view is that when they're selling all of their goods overseas, they're now receiving less foreign currency. Because in the example we talked about, the product that was being sold at 6.7 yuan was previously bringing in $1. However, today it's only bringing in 92 cents. And this means that China is now suffering on a number of different fronts. So what's the summary and conclusion today? Well, I wanted to post this update on the Chinese economy because obviously it's interesting from an economic perspective, but it's also really important when you're looking at the global economy, because China is the second largest economy in the world. It's the biggest country in terms of manufacturing, but it's also a major purchaser. Lots of countries are doing two-way trade with China. So when the Chinese economy starts to struggle and slow down, that means that all of the countries that are doing trade with China are also going to suffer, because if you're exporting goods to China and they're buying less, that means that you're making less profit in your economy, and so your economy might also start to slow down. And the data that we've seen in today's video is really concerning. China is dependent on its exports, and exports fell on a year-on-year basis by 12.4% in June, which is the biggest fall that China's experienced for more than 3 years since the COVID pandemic. And this has sent alarm bells ringing all around the world. And as we saw from the data that we looked at, it's not just exports. China's imports are also falling, and as those imports feed directly through into future exports, it's likely that we're going to see a continued fall in exports over the course of the next 3 to 6 months. But it's not just exports where China is struggling. As we've also seen, inflation is now at 0%, and not having enough inflation is an equally big problem to having too much inflation, because it means that none of the companies in your country will be able to pass on any cost increases, nobody is going to get a pay rise, and we start to see a lot of stagnation. And when you look at the trend as to what's happening with inflation, it looks extremely likely that China is going to move into negative territory. We're going to see deflation, prices actually falling year on year, which does sound a bit bizarre because we've been talking about extremely high rates of inflation for the last 18 months all around the world. But unfortunately for China, they've got the opposite problem. And we've seen the data from the factory gate prices, which are already running at minus 5.4%. So that means that factories are selling things today for 5.4% less than they were this time last year, despite the fact that everybody has experienced cost increases. So what that means is that the bottom line, your profit, is going to be directly hit because you're going to have to absorb all of those cost increases and you'll be paid less for selling your products. And the data that we saw from the Purchasing Managers Index tells us that companies in China, on average, are contracting right now. Everybody's cautious about what's going to happen in the future, and the continuing fall in the value of the Chinese yuan is accentuating all of the problems. So the overall summary of today's video is that the Chinese economy is currently in the middle of a crisis. Exports are down, imports are down, inflation is down, factory gate prices are down, the Chinese yuan is down, and business confidence is down. And the outlook for the next 3 to 6 months is very negative. So that's obviously really bad news for China, but it's also bad news for the global economy because, as I mentioned right at the start of this section, China is the second largest economy in the world. So when it contracts, it's going to take the global economy with it. And the continued contraction of China is now raising the likelihood of more and more countries going into recession at some point over the course of the next 3 to 6 months. At the start of 2023, everybody was hopeful that we would see a recovery, a bounce back, and that things would get back to normal. However, as it stands right now, the data that we're seeing coming out of China isn't telling us that that is going to happen. The more likely outcome right now is that we're going to see a global slowdown and potentially another recession. So hopefully you've enjoyed today's episode, you found it useful, informative and thought-provoking. If you've liked what I said, then please give me a thumbs up. Thank you for watching this video all the way through to the end, and here's something to put a smile on your face.